Joining me now is Yahoo Finance's Adam Shapiro. Adam, your take on the decision today, largely in line with expectations, but there's a lot more to come in the hour.
Right, and when we hear from Miles, some of the things you're looking for in all of this are the words gradual, because we had Vincent Reinhart, former Fed. He used to write these statements for the FOMC in the early 2000s. If you see the word gradual, it doesn't mean they've put a pause forever on raising interest rates. You could see one or two more this year, is what he was telling us. So this is all in play right now, but everybody expected they would hold interest rates today. Might set us up perhaps for one after March.
And they said that they would remain patient. It seems that's what they're doing.
Yeah, it's stable. They pledged patient is the key word. And by the way, it was Vincent Reinhart who first wrote patience into a Fed statement back in 2004. This is them listening to the markets, but they can hide behind the statements of data dependency and what's happening in the markets. Right?
All right. Well, I want to get straight to Yahoo Finance's Miles Udland. He is joining us by the phone from Washington, D.C. Miles, dig into this for us.
Hey, Jackie. So I think the big story here is the Fed not just releasing its regular policy statement, but also releasing what it calls a statement regarding monetary policy implementation and balance sheet normalization. Of course, we all know that the balance sheet has become a fixation for financial markets. The Fed basically re-outlining what the goal of the balance sheet runoff is, which is basically to get the balance sheet towards something that's more normal, though the Fed is stating that the balance sheet will remain part of its policy. So, you can guess at what the size is going to be. It's not going to be the $500 billion it was before the crisis, but it's not going to be the $4 trillion that it was after the crisis. And I think it's very interesting that the Fed is taking this first opportunity where Powell will speak to the media, who will speak to markets after the statement, to kind of go through how he's thinking about things. I mean, he writes that, or the Fed writes, that after extensive deliberations and a thorough review of experience to date, they want to update their thinking on the balance sheet. So, again, the Fed continues to figure out, the Powell Fed that is, how to talk about the balance sheet, how much of a role it plays in policy. On the one hand, the Fed wants to de-emphasize how big a role it plays. On the other hand, it's letting markets know we are listening to you, and we know that what you care about is the balance sheet.
And what's interesting here is, Miles, as you've dug into this a little bit more for us, so has the street, and you can see that the Dow has jumped on this particular news. We're seeing the Dow trading higher by 332 points right now, so taking about an 80-point move higher there. Adam, your thoughts on the balance sheet commentary coming from the Fed?
Well, they're reacting to the market. This is an organization that used to talk about its independence, so they've sent a message: we're listening to you, to the markets. But when you look at the buildup to what they are now doing, which is the roll-off, $50 billion every month, on a balance sheet that's $4 trillion, it was always designed to be very small, very slow, and so quiet in the background that nobody would even notice it. And the thing they can't actually measure, as you listen to different analysts, is if we continue this roll-off, how does that really impact liquidity? And we know how it impacts markets, but in the real world, what's the real impact? And that's not something the Fed can readily put its finger on. The other issue is that the Treasury Department is going to be selling huge amounts of debt to finance a $1 trillion deficit. So that's all in play, and the Fed has no control over that either. Right,
and it's a double-edged sword, right? Because on one hand, you want the Fed to say we are listening to you. At the same time, the Fed is supposed to be acting independently, and you don't necessarily want them listening to too many different influential factors, right?
You want them to be independent.
Right.
But we saw what happened when Chair Powell made the mistakes in December. We had the volatility, and then you saw different Fed bank presidents come in. I mean, here are the statements we had from, for instance, John Williams, when he said 12 months later, he was talking about how the economy had started very strong in 2018, well above trend. Interest rates still were quite low. Gradually rising rates was the obvious and necessary choice. 12 months later, the tailwinds have lost their gust. That was John Williams just last week.
Right. And you can see what an impact these statements have on the markets. Markets really react to them.